Cheng in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, a blow for Uber. New York City caps new licenses, stalling growth in one of its biggest markets. Could other cities follow? Plus, Twitter CEO Jack Dorsey is on the defense about the platform's policies on content. We will hear from diversity advocate and former Reddit CEO Ellen Pao, who says this could wipe out Twitter's recent progress. And Samsung unveils its Note 9 to the public. We'll gauge early reaction and discuss the tech giant's bigger strategy to take on the competition. But first, to our top story. Ride-sharing has been a booming business in New York City, thanks to the likes of Uber and Lyft. In 2015, there were nearly 13,000 ride-shared cars. 3 years later, more than 80,000. But all that could be about to change. New York City Council has approved a one-year cap on granting new ride-sharing licenses, giving regulators the authority to set minimum wages for drivers as well. New York Mayor Bill de Blasio tried passing a similar bill 3 years ago, but was shot down by the same council. This comes after Uber and Lyft proposed a $100 million fund to help bail out struggling taxi drivers, a proposal that New York rejected. With us now to discuss, we've got Arun Sundararajan, professor at NYU Stern School of Business and author of The Sharing Economy, The End of Employment and the Rise of Crowd-Based Capitalism. Also with us in London, Bloomberg's Caroline Hyde, where, of course, Uber just had to appeal the possibility of its license getting completely withdrawn. They've got a now shorter license, but certainly, Caroline, Uber fighting these regulatory battles around the world. How big a blow is this particular situation in New York?
I think this is a blow, particularly for the rest of the U.S., particularly if this sets a precedent, because this is the first major U.S. city we've seen install a cap on renewing, allowing new licenses for 12 months, one that both Lyft and Uber are saying, well, we're now worried about the natural attrition rate by people deciding they no longer want to be Uber drivers. How do we replace them? How does that limit supply? But there's also, of course, this cap, this support for earnings. Now, interestingly, this is something that Uber themselves said they supported. They said that actually this helped them really monitor supply and demand. In short, what they were saying is that they can naturally find some equilibrium so they weren't underpaying people by flooding the market. But I think this could become a precedent that we've seen unfold around the rest of the United States. We know that they've had regulatory battles in Austin, Texas, for example, where they had to back out and then they renewed and went back in. But not just in the US, but globally, they've had regulatory issues in Canada, in Italy. I've seen issues when I lived in Berlin that they couldn't get anything but licensed taxis using Uber. So notably, this is something that we could see unfold around the rest of the world and might not just be limited, therefore, and they're going to have to subsidize the prices and the earnings of car drivers worldwide, potentially, and indeed start to limit their growth. How do they vindicate that $62 billion valuation?
Arun, what do you see as the implications here for not just Uber, but also New Yorkers?
Well, I think we're going to see a drop in the quality of ride-hail service in New York. I've been frustrated by the storyline that Uber and Lyft are solely responsible for the increase in congestion that we've seen in New York. I'm sure they play a role, but we've also seen unprecedented population growth. We've got all these e-commerce delivery trucks parked in small roads, sort of jamming up traffic. The subway is crumbling, so people are looking for alternatives. So I don't see the approach of targeting just one contributor as being sensible. So I think the one sort of public transit service that New Yorkers really look to, and that has steadily been increasing in quality over the last few years, is now going to be capped. And I think it's really going to hit the people in Brooklyn and Queens, because once you have a cap on the number of cars, as demand grows, the cars will migrate away from the outer boroughs and to the more profitable Manhattan market. So overall, I think that the cap by itself is bad news for New York. The minimum wage, let's wait and see.
So in addition to a cap, what would you advocate? Would you advocate some sort of additional legislation here?
Well, I think there are two separate issues here, right? One is we think that there may be an increase in congestion, and the other is we don't think drivers are earning enough money. I think lots of people feel that drivers are not earning enough money in certain markets. Academically, this proposal for a freelancer minimum wage seems interesting. I don't know what the unintended consequences are going to be. It might sort of channel a lot of demand towards the more skilled drivers and sort of leave the other drivers out of the market and shrink the driver pool. But on the congestion front, like many people, I'm in favor of some sort of congestion pricing where, you have a higher price that you pay or a higher sort of toll that you pay during peak hours in areas that actually sort of are suffering from increased traffic congestion. Simply capping the number of Uber and Lyft cars, on the other hand, isn't actually going to make a dent in this congestion. It's just going to take cars away from the outer boroughs and into the congested sort of midtown Manhattan.
Caroline, elaborate for us on the arguments on both sides that this could help or hurt consumers.
Yeah, I think there are arguments that to a certain extent it could hurt consumers, like we're just hearing, limiting supply, particularly in the outer boroughs such as Brooklyn and Queens. And also, I think this is why the ad campaign that was so virulent the last time, in 2015, this is what de Blasio tried to pass, and it failed to get through the council, I think in a large part, because Uber and Lyft, they managed to strike a really heartfelt campaign that in particular this would limit cars going to those of ethnic minorities, and they felt that in some way perhaps yellow taxis had been underserving that particular population, and that seemed to pull at particular heartstrings at that point. This is something that needs to be tackled as to whether there is any lack of equality if particularly you come out of the suburbs and you focus particularly on the wealthier Manhattan, and that's because you can really boost up your earnings. So this could hurt consumers in that respect. And as in many had been saying, that this isn't actually going to tackle at the root of the problem when it comes to congestion, because this is to do with freight, this is to do with tourism, this is actually to do with purely more ride-hailing companies out there. But this is something that we're going to see, many a city and many a country have to grapple with, how you really tackle regulating these sorts of companies. Here in Europe, we had just earlier. Sorry, do go on.
I was going to say I agree completely. I mean, I think that we've seen different sort of experiments with regulation roll out over the last 6 years around the world. I think a lot of people thought that there would be a domino effect after London banned Uber. But I think that we've reached a point where, while many cities around the world will be waiting to see what happens in New York, I think in particular with the minimum wage, perhaps also with the cap, I'm not worried for Uber and Lyft that a whole bunch of other cities are going to jump on the bandwagon and say, we're going to cap Uber and Lyft as well. Because I think, smart city governments realize that this is the future of public transportation, that this is something that their citizens like. And so, New York City does have the unique problem of having to deal with sort of millions of dollars spent by people on medallions, and how to address that problem. But I think that that's a problem that's unique to New York City. But anyway, it's interesting days for regulating the sharing economy yet again.
For sure. Professor Arun Sundararajan of NYU and our very own Caroline Hyde in London, thank you both. Coming up, we continue our look at the fallout over Jack Dorsey's defense of Twitter not banning Alex Jones. Our discussion with Ellen Pao, the former Reddit CEO, is next. This is Bloomberg. Twitter CEO Jack Dorsey continues to defend Twitter's refusal to ban conspiracy monger Alex Jones. On Wednesday, Dorsey appeared on the Sean Hannity radio show to once again reaffirm his stance.
I think the first thing is that we, in the past, we did not communicate why we would take action on tweets or why we might suspend temporarily or permanently. We wouldn't communicate those reasons to the person who was suspended or tweets in question, and also the reporters. So simple communication within the product, but more broadly, we haven't done a great job at communicating our principles, the guidelines that help us make the decisions in the first place. So we're getting better and better step by step, but we have a lot more work to do there.
For reaction, we went to someone intimately familiar with the perils of online hate speech, Ellen Pao, who was the former interim CEO of Reddit. After she resigned from that role, she issued a post saying, "In my 8 months as Reddit's CEO, I've seen the good, the bad, and the ugly on Reddit. The good has been off-the-wall inspiring, and the ugly has made me doubt humanity. Before that, Powell was a partner at Kleiner Perkins, where she wanted the firm to invest in Twitter back in 2007. The company passed, but eventually invested in 2010, and Powell later sued the firm for gender discrimination. She lost that case, but has since become a vocal advocate for diversity and equality in tech, and is today the CEO of Project Include. We started with her reaction to Dorsey's defense.
It feels like he's standing on his own, and he really feels like he can change Twitter on his own without following what has happened in the past, without seeing what other platforms are experiencing, and without learning. So that's the piece that really surprises me. We've learned so much in the past 5 years, and he's not incorporating any of that, building any empathy for the people who are being harassed on his platform, and instead he believes there should still be this free-for-all on Twitter that he can somehow control and manage.
It also seems to reverse some of the progress that Twitter has actually made in the last 2 months.
It's confusing to me. It's a surprise that he would not take this opportunity to really protect people on his platform who are being harassed, and I've seen people leaving the platform, and I've not decided for sure that I'm going to leave, but I'm not tweeting. I haven't tweeted for a day, and I don't feel like participating anymore. You feel like you're contributing to this site that is allowing harassment, that is allowing these hate speech and the harassment that comes from it on the platform, and contributing to it if you're participating in it.
Now, despite the fact that Facebook, Google, Apple, Spotify have all taken action against Alex Jones, the app, InfoWars, is rocketing up on the app charts. It's more popular than CNN, the New York Times, even Fox News. Is all of this hubbub just helping him?
We'll see, right? The jury's still out, but at least the people at those companies can feel like they have at least stop their platforms from spreading it as much as possible. Apple, with keeping it on its platform, I'm not really sure. Google,
it's still in the App Store, but they
exactly.
took off some of his podcasts.
Yeah, you make it a little bit harder. You put some friction into it. It's better than doing nothing, which is what Jack is doing.
Mm-hmm. So Kara Swisher wrote a post about how rules won't save Twitter, values will. I mean, the rules, to be fair, have never been clear at Twitter, nor has how they enforce the rules. But forget about where you draw the line. Is there a different way to draw the line? How you draw the line? Could Twitter do that differently?
So I am empathetic to the problem, because the rules can't address all the changing circumstances. So you have this clear rule, but people are trying to get around it, and you'll make mistakes, and it's always a problem. It never seems clear. But here, in this case, this is a person who is perpetuating harassment across the internet, and your product is being used as a tool for harassment. And these families who have had to go into hiding, like, where is your empathy for them? Is this what you want your platform to contribute to? I don't understand how you can keep this, encourage this type of information and encourage this use of your platform.
There's also the question of whether and how offline behavior should be considered. So Alex Jones, for example, could be potentially guilty of perpetuating violence against these families off the platform. How much should a platform like Twitter or Facebook consider that?
So we had this horrible experience at Reddit in 2013 in April, where people were trying to figure out what was happening in the Boston Marathon bombing, and somebody incorrectly identified a student as a potential person the potential bomber, and that person was a missing person. His name was Sunil Tripathi, and his family got harassed. They said terrible things about him all over the internet. And what I took from that is that, no, you can't just look at what's going on your platform, and it doesn't matter what people's intents are. They're trying to, find the bomber. The frenzy that social media creates, and the immediate actions that people take without thinking, and the immense harm that inflicts on individuals for no apparent reason, like that is something that you need to take into account. The fact that you're not the only reason doesn't mean that you're not a contributing factor, and doesn't mean that you abdicate all responsibility.
Given what you saw at Reddit and the choices you made, which were at times hard choices, if you were running Twitter right now, what would you do?
I would take that content off. I would really look hard at, offline and online. And I think Del Harvey sent out a message saying they are doing that. But
Del Harvey, who's running
Trust and Safety
right now.
And I think she's a very smart person. I think, this is your opportunity to really be transparent. Like, where are the rules? Where do you want people to behave, and where are you going to take people off the platform? And harassment should be one of the key things. This talk about free speech, when people like Lindy West, when Ta-Nehisi Coates, when others are coming off your platform because they don't feel like it's safe for them to share their ideas, and these are people who have resources, who are are out in the public eye in general, and they don't feel like your platform is safe for them, then where is the free speech? Where is the sharing of ideas? Where are these healthy conversational environments?
Now, even though Facebook took a stand against Alex Jones in this particular case, it's a platform that also continues to have a problem with how to deal with these issues. You recently tweeted either they don't understand, they don't get it, or they just don't care. Do you think that we saw for the first time Snap having a decline in sequential users? We saw Facebook have a decline in users in some regions. Do you think we've hit a social media peak?
It's a good question. I think people are realizing that it is, it's taken a while, but people are finally realizing this is not a wonderful utopian area of communication and change. It's become addictive. People are now putting in tools to track how much time of their users are using it, so that users can monitor and manage their time on these different sites. The harassment problem has become very evident, and and then you also see the discrimination and the bias in the products. And I think people are now realizing, this is not where I want my kids all day long. This is not where I want to spend my own time. So how do I manage that? And as people get smarter and they realize that, this is not the best place for having a conversation, for learning new ideas. There's so much fake information out there. There is hopefully going to be another source where people are going to get information and have better conversations.
There's an author who wrote a book called Anti-Social Media who says there's nothing we can do to stop hate speech and misinformation on social media. The genie's out of the bottle. Would you agree, or is that too fatalistic?
I don't know. I think it's a good question. I don't think we have a CEO who is really willing to go out there and see if that's true or not. I think the actions that people are taking are kind of tepid, and it's let's follow somebody else if they do something, but let's all follow Apple. But then Apple was kind of, half-hearted in it because they continue to allow the app in its app store. So I'm not sure how we actually know if we can change it or not, if people aren't willing to experiment and take risks and really try to solve the problem.
You think a Twitter boycott could take off as a result of this?
I hope so, but it's hard because I'm thinking about I don't want to be on the platform, but is it feasible? I was sitting in earlier and I hear how you're talking about at Bloomberg, go follow our Twitter feed. Here's our Twitter handle, and people are using it as a tool for sharing information and for communicating. And is that going to be good for for my company, for my nonprofit Project Include, if I'm not out there promoting the ideas and sharing and learning from it? So I don't know. I think it would be good. I think Uber changed when Delete Uber became a trending hashtag, but that may be the only way. I don't know what Twitter's board is doing. I'm kind of surprised that they haven't stepped in. I don't know where their heads are at, but this seems to be a pretty clear area where it needs some real leadership.
Right. Where is the board? You famously, in your case against Kleiner Perkins and in your book, talk about how you wanted to invest in Twitter back in 2008. They declined and then decided to invest in 2010. What do you think now?
It was 2007, and there was so much opportunity. You can see how it connects people, and I've met so many wonderful people. I've had so many great conversations, but the harassment and the abuse, it's just too much. And then when you see what's happening offline, it's just sad because there's so much potential, there's so much good that can come from it. But unless Jack can understand like what that harassment looks like and what that feels, to have your kids harassed, to have your dead kids harassed, I can't even imagine what that must feel like.
Last time you came on the show, you said that you thought Twitter should ban Donald Trump. Do you still believe that?
Yes, I think it's even worse, if anything. I don't follow him, but I see some of the, kind of fumes coming out in other people's tweets, and it's too much. What are your rules if they don't allow you to ban Donald Trump or, people who are making up information to harass other people?
Our discussion with Project Include CEO Ellen Pao. Coming up, the Elon Musk suspense continues. Can he keep investors on board if Tesla goes private? And regulators are already looking into whether he's violated SEC standards. We will discuss next. The U.S. SEC is intensifying its scrutiny of Tesla's public statements in the wake of Elon Musk's provocative tweet Tuesday about taking the electric car company private. Let's get straight to Bloomberg's Matt Robinson, who covers enforcement with more. And Matt, as I understand it, it's not Musk saying that he intends to take the company private. That's the issue. It's that him saying funding is secured is the issue, correct?
Right. Well, what the agency is looking at sort of broadly is how the statements, they're looking broadly at statements about, if they're factually accurate. Anytime a company CEO makes a statement, there needs to be, a reasonable sort of understanding that, this can be done. So that, what we wrote is sort of the SEC looking sort of more broadly at statements throughout. So, but it's good to point out that this is very preliminary, very information gathering stage of what the agency is looking at.
Right, but should they find information that they believe Tesla or Musk violated its standards, what could the repercussions be?
Well, that's very far off right now. But anytime they would need to show that this was really kind of far off. I mean, in these types of cases, it actually tends to focus on more on biotech of like, hey, we have a new drug and we're getting closer, and they need to have a basis for those types of statements. So I mean, if they found something that hey, they were really far off, or something really was not matching up with their if things weren't matching up publicly with what he said internally, the SEC could bring an enforcement action.
Okay. Bloomberg's Matt Robertson, great scoop from you. I know you'll continue to follow and keep us updated. Thanks so much. Coming up, we will take you behind the scenes of Samsung's Unpacked event in New York as the company unveils its priciest phone yet. Will this device help rejuvenate sales? We'll discuss. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. About 2 years ago, Samsung rolled out its highly anticipated Note 7 device. What was planned as its crowning achievement and greatest shot to take on chief rival Apple became a disappointing turning point for the company. There was a design flaw that caused devices to spontaneously combust, leading to recalls and apologies that cut into profits. The company is hoping its Unpacked event this Thursday in Brooklyn, New York is the start of a new chapter, however, unveiling the Galaxy Note 9 that starts at $1,000. For more, I want to bring in Bob O'Donnell, president of Technalysis Research, and our very own Mark Gurman, who attended this event. So, Mark, what's your take on the specs of this new Note 9, the good and perhaps the not so good?
Sure. I mean, they're really positioning it as a huge leap forward, this new big thing for consumers, but the reality is what looks new is new to consumers, and this phone does not look much different than its predecessor, the Note 8. It has a slightly bigger screen, a much upgraded stylus, more storage capacity, a bit of a faster processor, but I don't think that's enough to move the needle to spur upgrades from the previous model.
Bob, you were there as well. Would you agree?
Well, generally I would agree. The difference is, I would say, people aren't upgrading every year for any phones anymore. And so the market realities have changed, right? People are now upgrading every 2 years, every 2.5 years. So when you think it from that perspective, and you have people who have older Samsung phones, it's nice. But look, Mark's right. It's incremental at best. You know, the phone or the pen technology is kind of interesting. There were more interesting announcements later in the event, and frankly, if you look at the time spent across the entire event, the time spent on the phone was actually relatively modest because it was a relatively modest upgrade.
Now, Mark, you've done some incredible reporting on the iPhones to come. How does what was revealed today compare to what you expect Apple to unveil in the fall?
Well, that's very kind of you. It's a team effort, but it fits right into what we were expecting from both Samsung and Apple this year. Not really significant upgrades. Apple's upgrade is not very significant in September on the feature side. It's significant in how many different versions of the iPhone 10 they're going to have now, different screen sizes, different pricing strategies. So it's really going to be an exercise in marketing, and I think that's the same thing going on with the Note 8 now, given it's not that big of a leap as well.
Look, Bob, there have been questions about whether customers are going to pay that $1,000 for the iPhone 10. Same question here. Do people really want to pay that much for a Samsung phone?
Well, look, if Samsung has any Apple fanboy, fangirl equivalent, it's the Galaxy Note owners. They are the most dedicated, most faithful to the brand folks. And there are people in that group who want the best Android phone, and I think they will. And by the way, the 512 gigabyte model is actually going to be $1,249, so they're at an even higher price point there. So, but again, this is not the entire market. This is, and Samsung knows that, this is their dedicated Galaxy Note people, the people who like using the pen, which is why the primary focus of the new features were around the pen. And so from that perspective, it makes a lot of sense. But to me, what's more interesting, and Mark and I were chatting a little bit about this, is the Spotify news. To me, that was interesting because it reflects a bigger picture strategy story from Samsung across the board, across all their different devices.
And how does that, Mark, compare with Apple, which of course has Apple Music?
Yeah, no, that's a good question. So Spotify at a low level is not going very much in-house. They're not building up this new streaming music service themselves. They used to have one called Milk. I think they've had a few others over the years. They've sort of terminated all of those projects and now partnering with Spotify, which I think still has the top best brand recognition for any streaming music service. It's a smooth move by Samsung. And even Spotify investors seem pretty impressed by it. If you look at the Spotify stock, it's up several percent this morning just from this announcement.
Other product announcements: a revamped smartwatch, a home digital speaker. Mark, you've been tweeting about the size of this speaker, 1.5 times the size of the HomePod, which is already quite large. What's your take on these other products?
I mean, the Galaxy Watch is a revamped version of the smartwatch strategy they've already had for the past few years. I don't think it's going to move the needle. The market has truly become saturated at that $300 to $800 price point with the Apple Watch. Fitbit really has the sub $200 price point, so I'm not really sure where Samsung is going to fit in there. On the other hand, the home speaker, it's also coming in extraordinarily late, right? The Amazon Echo came out, what, 3-4 years ago, announced in 2014, so almost 5 years ago now. The HomePod was late as well, coming out in February earlier this year. But Amazon and Google Home really have a handle on that market. So I'm not really sure what percentage of the market Samsung is going to be able to grab with this device, especially with such few details they're providing on this. I wouldn't be surprised if it's not released until the very end of this year, early 2019. So they're extraordinarily late to the game here on the Galaxy Home speaker, and it does not appear that they're bringing any new innovative functionality to the table that would inspire anyone to buy one of these things.
Bob, is it too late for Samsung and Apple in smart speakers?
Well, it's going to be very challenging. As Mark pointed out, you've already got a very strong position for both Amazon and Google. Look, the one thing I will say across the board for the different Galaxy products is we are seeing Samsung talk about Galaxy brand. It's interesting that they changed it to Galaxy Watch and they call it Galaxy Home. They're trying to build this overall connected device story, which I think is a unique opportunity for Samsung, because when you think about all the appliances they make and all the other things they do, they are the only company in the world that potentially can do that. But again, the real test is going to be in the execution. How well does Bixby actually work on that speaker? Having Spotify bundled with a smart speaker, I do think is attractive, and that is a unique opportunity from them from a general music perspective. But look, it's going to be an uphill battle.
Mark, you recently did a deep dive on Apple's failure to capture the India market, where companies like Xiaomi and even Samsung have surged ahead. How does what was announced today position Samsung to compete globally compared to Apple?
You know, that's a good question. I think this really comes down to this head-to-head battle that Apple and Samsung are about to go at. This Note 9 and the upcoming iPhone 10 Plus, which is going to be a bigger screen version of the iPhone 10 that Apple's been working on for quite some time. Those are going to be two really hot devices on the market this fall, and they're going to have a lot of competition against each other in the US, Europe, but especially in Asia, where there's a lot of one-device consumers, people who do everything from a single device. These bigger screen phones allow people, business users, students to get a lot more done than they normally would on a smaller smartphone. So I think that's what really the story of the latter half of this year is going to be in terms of smartphones. It's going to finally be Apple and Samsung going toe-to-toe with high-end technology in large phablet-sized devices.
All right, Bloomberg Tech's Mark Gurman and Technalysis Research President Bob O'Donnell in New York today on Samsung. Thank you both. Well, Deutsche Telekom is forecasting higher full-year earnings bolstered by growth in the United States. That underscores the importance of a planned deal for its U.S. unit T-Mobile to buy Sprint for $26.5 billion. Deutsche Telekom is the market leader in Germany and elsewhere in Europe, where growth is hard to come by. Coming up, from Uber to Airbnb, the waiting game for IPOs is getting longer. Why high-profile startups are still opting to stay private. Next. This is Bloomberg. Even as more tech companies go public, a slew of high-profile startups like Uber are opting to stay private for as long as they can. So investors and employees are finding more ways to trade shares privately. According to a new report from NASDAQ Private Market, which helps companies facilitate shareholder liquidity, deals in the private market have grown dramatically this year. For more, we are joined by Nelson Griggs, president of the NASDAQ Stock Exchange from the NASDAQ market site in New York, as well as Bloomberg's Julie Verhage, who's been reporting on this story. So, Nelson, according to your report, you saw $10 billion worth of private shares change hands in the first half of this year compared to $733 million in the same period a year ago. What's driving that kind of volume difference? All I can think of is Uber.
No, it's a group of companies. We don't talk about specific companies who use the platform, but you have a lot more activity this year. We saw at least 50% more companies conduct these private transactions, and it's really driven by the fact that they've changed from company buybacks to third-party tenders. So new capital coming into the company in the form of secondaries. So that's driving a lot of the activity.
So are these shares typically trading at a discount to the latest private valuation, or are employees and insiders getting more for their money?
Well, typically anytime you do a transaction, there will be some discount to the last preferred round. It will vary from company to company. It'll also depend a bit on how the public markets are reacting. And you know, today the public markets have a fairly high valuation. So I think you're seeing, we've done 35 programs this first half of the year, so I couldn't comment directly on one company, but you are seeing probably a slighter discount this year than you have seen in past years.
Julie, what is so appealing about this to employees? Is it just the liquidity? And does it not matter, Julie, whether it's coming from a third-party outsider or from the company itself?
Right.
Yeah,
for employees on their side of things, usually if you're an employee at a startup and companies are staying private for a lot longer, maybe 10 or longer, you don't have a way to find liquidity. So these are great programs for employees if you want to do something like buy a house or get married or, start saving for something. This is a great way to actually get liquidity on that, paper money that Silicon Valley has come to know. And one thing that when I started writing about this, I wouldn't have thought that it had mattered whether it was a third party or a company buyback. But Nelson, you guys say that it actually does matter, correct? Why is that?
Well, it matters quite a bit because if you think about a company doing a buyback and they want to do this on a consistent basis, let's say a program a year or 2 programs a year, they have to be comfortable they have it on their balance sheet to perform those buybacks. Now that we've seen a big shift to the third-party tenders, more companies are participating. So as I mentioned, the number of programs we've done have increased at least twofold this year. So you're seeing that consistency of these offerings, the ability for employees to do this on a more regular basis because the companies are leveraging third-party capital versus their own balance sheet.
Got it. And I know, like you said earlier, you can't name any specific companies, but without saying a name, what were some of the largest transactions in terms of dollars that you guys have seen so far this year?
Right. Well, I will say there are names that we are able to talk about because the company has given us permission to do that. You know, one such a partner of ours in this process. It's a very innovative company. We did a larger program for them that was very broad-based. So I think I would say the range of size of transactions is very large. You have seen some, very big multi-billion-dollar transactions down to transactions that maybe just $20 million. So we're seeing a broad range of the number or the size of the deals. And then one thing you mentioned earlier about how long companies are staying private, that's been a big change for us as well. So typically companies doing programs, the average last year, they were private for about 10 years. That's come down to 6 years at this point. So I think the big changes we're seeing are, as mentioned, more third-party tenders than buybacks. We're seeing the programs more broad-based. So some of these large ones, we're even seeing institutions being allowed to sell a certain amount. And then we're seeing companies, really the third leg is seeing companies plan for these and have a real long-term vision of doing these on a regular basis. So a lot of our customers are repeat customers.
Nelson, we've seen a number of conflicting trends. We're seeing tech IPOs tick up. We're seeing people like Elon Musk talk about taking their public companies private. We're seeing companies like Uber and Airbnb wait even longer to go public. What do you see over the next year, 2 years? Will tech IPOs continue to rise or will they slow back down?
Yeah, well, this has been an amazing year for the number of tech IPOs. So we're seeing even a higher degree of IPOs than we saw in 2014. We predict a very robust fourth quarter, end of third quarter, fourth quarter, where it's going to be very, very active. So in the broad spectrum, a lot of companies, a lot of software companies going public. You do have some of the larger ones, names you highlighted amongst others, that are taking longer to go public, which is part of the process of being able to get access to private capital and wanting to solidify their business plans. And then you do have some long-term companies. You mentioned one in particular, but I'd say those are few and far between in terms of wanting to go private. Although clearly, if it's right for the company, they have that the ability to do that.
And lastly, we saw a huge rise in private transactions like this pre-Facebook, and then there was a big crackdown. Could that happen again?
Well, I think that was a little bit more of a mechanism to why these transactions were happening. So we only go in the front door. We work directly with the company. We don't participate in activity outside of a company-sponsored program. But I think what we see driving this, if you look at how many $100 million private rounds have been raised this year, there's been 94. Versus, the 2013, for example, was only 26 all year. So you're seeing a lot of private capital that is going to sustain this marketplace for a while. And now valuations can change, and there can be a disconnect at some point that can slow it down a bit. But with all that private capital out there, the investor bases are growing. I think you're going to see it continue.
All right, Nelson Griggs, president of the NASDAQ Stock Exchange, and our very own Julie Verhage. Thank you both.
Thanks for having us.
Coming up. What exactly happened when Elon Musk spoke with SoftBank last year? Some of our exclusive conversation with SoftBank COO Marcelo Claure next. This is Bloomberg. SoftBank is eyeing a world of disruptors. COO Marcelo Claure, who's also the chair of Sprint, spoke exclusively with Bloomberg's Ed Hammond at Sprint HQ in Kansas. Claure says artificial intelligence will be the next big thing SoftBank looks to invest in, and also discussed Elon Musk after Bloomberg reported that SoftBank had talked with Tesla in April 2017 about investing in the company and potentially taking it private. Take a listen.
It's a company, like every great company, is always in evolution, and it's a company that is evolving. It was a company that traditionally was a telco, right, with SoftBank Japan in being one of the most disruptive telcos in the world with Sprint, and also it has always been a technology investor. But as Masa had made it very public, he wants to focus the company on technology investing and transition to being more of an investing company than an operating company. And this is why, you hear about the potential listing of our Japanese telco. This is why we're doing the deal with T-Mobile in terms of now Sprint potentially becoming a 20-something% ownership that the group will hold. This is why, we're we're going to look at what we do with other businesses that we have 100%. So the thinking is, if we've done so good at investing, why don't we put most of our attention in terms of potentially investing large amount of capital in the technology and disrupting the way the world lives. So that's where we're putting most of our attention today.
But when you talk about technology, SoftBank gets linked with every technology deal that seems to pass the tape. What is the unifying theme behind SoftBank's thesis in terms of where it's investing?
I mean, you heard Masa say that artificial intelligence will be one of the unifying themes, if not the most important unifying themes. If you look at before, the PC played a key role, then we moved into internet, then we moved into broadband, and we believe the next enormous wave of disruption is going to be powered by artificial intelligence.
Another thing Masa talks a lot about is this sort of cluster of number ones, having the portfolio companies all talk to each other. How do you as COO facilitate that? Well,
that's my primary role. My primary role is we have started something that's called the SoftBank Operating Group. And our job is how can we help the different portfolio companies, not only the Vision Fund, but when you look at the entire portfolio, it's many hundreds of billions of dollars, and how can we make our companies work better in order for us to generate a better return? How can we help these entrepreneurs basically be able to grow faster, expand faster? So that is one of our primary roles. When we sit with an entrepreneur, it's fascinating to be able to say, yes, we do have financial capital, and we are the largest tech investor in the world. But at the same time, we're going to help you in other areas. One, we have probably the most exciting ecosystem in the world. When you look at our portfolio of companies that we have, it's incredible. I mean, we have the world's leading technology companies, the emerging companies together, and we find that our entrepreneurs love to do business among each other, so we're facilitators, we help them. We also see some of our entrepreneurs have done an incredible job of bringing a technology to one specific country. So we figure out ways in terms of, once they're ready, how can we help them basically expand their business to other parts of the world? And then lastly is how can we help them grow their business? A lot of these are new companies they might be IPO ready soon. And as you know, being an IPO ready company is very different than just being a company with a great product. So we try to help our entrepreneurs basically unleash their full potential, and that's one of my primary roles.
But this notion of transition and evolution, and obviously Masa talks a lot about this, it makes sense for SoftBank to be doing this, but if I'm an investor in SoftBank, what exactly am I holding? Because the company today is going to be very different in 5 years. So how do I quantify my investment?
I mean, I think the best way to look at it is look at the track record of SoftBank, right? When you look at the track record of SoftBank as an operator, I think we've done an outstanding job. I mean, the turnaround of SoftBank AK, the Japanese telco business, has been probably one of the best turnarounds in history of telecom. When you look at what we've done at Sprint in terms of putting Sprint where it is today and ready to merge, has also been remarkable. Now, when you look at the track record as an investor, I mean, the amount of money that SoftBank has invested and the return that has generated is probably the best in the world. So what we decided is, why don't we put more focus in basically replicating and putting our money to work in areas that we've done good in the past, and then be able to invest and put most of our attention in investing in these entrepreneurs and helping them grow their business.
So an entrepreneur that you've been linked with in the last 48 hours, Elon Musk, how real was the interest in Tesla?
I mean, we would never comment in terms of if we ever had conversations or not. I mean, that wouldn't be fair to anybody, But one thing that I can tell you is most of the entrepreneurs today who want to do a big transaction or who are looking for a partner to help them expand their business, we will have conversations with them. I wouldn't know particularly if something ever happened with Elon or not, so we wouldn't comment anyway. But I mean, if there's a deal going on, there's a chance that we are going to be informed or we're going to be part of the conversation.
So that kind of company would sort of fit the bill in terms of the areas and the potentially the type of founders that SoftBank would back?
I mean, I would say that is more in Masa's area in terms of finding entrepreneurs that are going to disrupt the way we work, the way we live, the way we move, the way transportation gets disrupted. And Elon has been an amazing entrepreneur, and one that I think a lot of people admire. But like Elon, I mean, we look at there are so many incredible disruptors today that are leveraging artificial intelligence to change the way pretty much everything gets automated in the world. And that's where we're putting most of our focus on.
That was SoftBank COO and Sprint Chair Marcelo Claure speaking to Bloomberg's Ed Hammond. Well, the U.S. Defense Department released a report to Congress outlining a plan for a space force with aggressive offensive capabilities, including systems that could, quote, degrade, deny, disrupt, destroy, and manipulate adversaries. Vice President Mike Pence also gave a speech championing a space force and called on Congress to allocate funds.
And today, we renew the President's call on the Congress of the United States to invest an additional $8 billion in our space security systems over the next 5 years.
President Trump took to Twitter, writing, "Space Force all the way," just a few minutes after Pence's speech, though many critics still question whether such a force is feasible or necessary. And that does it for this edition of Bloomberg Technology. I'm Emily Chang in San Francisco. This is Bloomberg.